Hi, my name is Nordanisha Farha binti Nur Azri. My matrix number is 01DKB20F2028.
Assalamualaikum and hi, my name is Auni Sofia binti Muhammad Masri with matrix number 01DKB20F2003.
Hi and good day everyone. My name is Tivia Anak Perempuan Mahindra Raj and my matric card number is 01DKB20F2010.
Assalamualaikum and hi, my name is Azrah binti Abdul Kajum and my matric numbers is 01 DKB20F2019.
Assalamualaikum and hi to everyone. My name is Nurdin Zafira binti Zainuddin and my number matric is 01 DKB20F2027.
Okay, the introduction is the Basel framework, also called the Basel Accord or Basel Standards. Okay, the full set of standards of the Basel Commit on Banking Supervisions, BCBS, which is the primary global standard setter for the prudential regulation. The membership of the BCBS has agreed to fully implement these standards and apply them to the internationally active banks in their jurisdictions. Now I will move to what is Basel I. Basel I is a set of international banking regulations established by the Basel Commit on Banking Supervisions. Prescribes minimum capital requirements for financial institutions with the goal of minimizing credit risk. Under Basel I, banks that operate internationally were required to maintain at least a minimum amount of capital 8% based on their risk-weighted assets. Okay, Basel I is the first of three sets of regulations known individually as Basel I, II, and III, and collectively as the Basel Accords. Now let's move to requirement for Basel I. The Basel I classification system groups a bank's asset into 5 risk categories labeled with the percentage 0%, 10%, 20%, 50%, and 100%. A bank's assets are assigned to these categories based on the nature of the debtor. The 0% risk categories consist of cash, central bank, and government debt, and any organizations of economic cooperation and development government debt. Public sector debt can be placed in 0%, 10%, 20%, or 50% category. Development bank debt, OECD bank debt, OECD securities firm debt, non-OECD bank debt, non-OECD public sector debt, and cash in collection all fall into the 20% category. The 50% category is for residential mortgage, and the 100% category is represented by private sector debt, non-OECD bank debt, maturity over a year, real estate plan and equipment, and capital instrument issued at other banks. The bank must maintain capital, referred to as Tier 1 and Tier 2 capital, equal to at least 8% of its risk-weighted assets. This is meant to ensure that banks hold an adequate amount of capital to meet their obligations. For examples, if a bank has risk-weighted assets of 100 million, if it is required to maintain capital of at least 8 million.
What is Basel II? Basel II is a set of international banking regulation established by the Basel Committee on Banking Supervision based on Basel, Switzerland. Basel II was released in 2004 with the goal of being phased in over a series of years. This is a second of 3 Basel Accords, has 3 main tenets, which are minimum capital requirements, regulation supervision, and market discipline. This Basel provides guidelines for the calculation of minimum regulatory capital ratios and confirm the requirement that banks maintain a capital reserve equal to at least 8% of their risk-weighted assets. Did Basel II replace Basel I? Basel II built upon Basel I, so it brought to refining and clarifying some of its rules as well as adding new ones, but did not replace it altogether. What was wrong with Basel II until they come with Basel III? It was because the beginning of the subprime mortgage meltdown in 2007 and the ensuing worldwide financial service crisis show that the regulation created under Basel I and Basel II were inadequate for curtailing the risks that some banks were taking and the dangers they posed to the worldwide financial system. I will pass the floor to Tivia. Thank you.
Divides the eligible regulatory of a capital of a bank into three tiers. The higher the tier, the more secure it is. The first tier represents the bank's core capital and also disclosed as common stocks as well as other assets. The first tier represents the bank core capital and it's composed of common stocks as well as disclosed reserves and certain other assets. Tier 2 is considered as supplementary capitals and consists of items such as revaluation reserves, hybrid instruments, and long-term subordinated loans. Tier 3 consists of lower quality unsecured subordinated debt. Firstly, I'm going to talk to you about requirement of Basel II. Risk component can be calculated in three different ways of varying degree of sophistication, namely standardized approach, foundation IRB, advanced IRB. IRB stands for internal rating based approach. For operational risk, there are three different types of approaches. Basic indicator approach is also known as BIA, standardized approach also known as TSA, and the internal measurement approach. For market risk, the favorite approach is known as VAR.
What is Basel III? Basel III is an extension of the existing Basel II framework and introduced new capital and liquidity standards to strengthen the regulation, supervision, and risk management of the whole of the banking and finance sector by increasing bank liquidity and decreasing bank leverage. Basel III was introduced following the 2008 global financial crisis to improve the bank's ability and to handle any shocks from financial stress and strengthen both their transparency and their disclosure. The figure below shows how Basel III strengthened Pillar 1 with enhanced minimum capital and liquidity requirements. For Pillar 1, enhanced minimum capital and liquidity requirement. For Pillar 2, enhanced supervisory review process. For Pillar 3, enhanced risk disclosure, discipline of market. Next is the principle of Basel III. There are four principles of Basel III. Firstly is capital requirement. The Basel III Accord increased the minimum Basel III capital requirements for banks from 2% in Basel II and 4.5% of common equity as a percentage of the bank's risk-weighted assets. There is also an extra 2.5% buffer capital requirement that brings the total minimum requirement to 7% in order to be Basel compliant. Banks can use the buffer when they face financial stress, but using the buffer can lead to even more financial constraints when paying dividends. Second principle is leverage ratio. Basel III introduced a minimum leverage ratio as a backstop to the risk-based capital requirements. The leverage ratio was calculated by dividing Tier 1 capital by the bank's average total consolidated assets. The banks were expected to maintain a leverage ratio in excess of 3% under Basel III. In order to conform to the requirement, the United States Federal Reserve Bank announced that the minimum Basel III leverage ratio will be 6% for systematically important financial institutions or known as SIFI banks and 5% for their bank holding companies. Third principle in liquidity requirements, Basel III introduced two required liquidity ratio, that is, first, liquidity coverage ratio or known as LCR ensures that sufficient levels of high-quality liquid assets are available for 1 month survival in a severe stress scenario. Second is net stable funding ratio, also known as NSFR, mandates that banks maintain stable funding above the required amount of stable funding for a period of 1 year of extended stress. Last but not least is changes to counterparty credit risk or known as CCR. Basel III introduced capital requirements to cover credit value adjustment, or known as CVA, risk, and higher capital requirements for securitization product. That's all from me. I will pass to the next presenter.
I will explain about Basel IV. First, what is Basel? In a simple word, Basel IV is continue and complementing the aims of Basel III. Basel IV is informal name for a set of proposed banking reform building on the international banking accord known as Basel I, Basel II, and Basel III. It is a final document on the reform of Basel III, which are commonly referred to as Basel IV. Basel IV will be a game changer, not only for banks, but also for corporate when it comes to access to financing. The regulation of finalists of Basel III will overhaul global bank capital requirement, changing the corporate lending landscape, and Basel IV changed the approach for the calculation of RWA. RWA stands for risk-weighted asset regardless of risk type and irrespective of whether standardized approach or internal models are used. Lastly, Basel IV reform like credit valuation adjustment (CVA) and leverage ratio and operational risk framework are meant to improve market making service availability and therefore the market shortfall created by Basel III. Next, requirement Basel IV. Basel IV introduced changes that limit reduction in capital that can result from bank use of internal models under internal rating. Best approaches include first, a higher leverage ratio, higher than the Basel III leverage ratio for global systemically important banks, with the increase equal to 50% of the risk-adjusted capital ratio. Second, requirement to bank under SA standard approach called output floor, which prevent a bank on internal measurement of its risk exposure from yielding less than 72.5% of standardized approach. At the maximum, it can reduce risk-weighted asset by 72.5%. This is a major change that affects how much benefit we can get from these internal models. It will affect banks that are using internal model the most. Lastly, even more disclosure for transparency among international banks. Summary of Basel IV. Basel IV, new requirement just like Basel III, aim to create a more robust capital framework and increase confidence in the banking sector. Some of the new measures that Basel IV introduced include the standardized of risk-weighted asset calculation used by banks and limit the use of internal rating-based IRB models. By doing so, the BCBS aims to reduce variation result from banks' internal models. Thank you, that's all from our group.